One of the most common questions entrepreneurs ask is, how do I raise funding for my startup? In today's video, I'm going to be sharing with you 8 ways you can raise funding for your startup or business, so stay tuned. Hey guys, welcome to another episode of Entrepreneur Weekly, the channel that is dedicated to upcoming entrepreneurs, where we talk about entrepreneurship and startup life. My name is Isaac, and if you have already subscribed to the channel, thanks for your support. All right, so let's jump right in. So startup funding is a very broad topic, and I obviously cannot cover all of the ways you can raise funding for your startup in one video. And so this is not an exhaustive list of all of the ways you can raise funding, but basically just the top ones that I believe are most applicable to African entrepreneurs, so that I just give you the basics, and then you can go and learn more if you want to. So with that out of the way, let's jump right to our first method of raising funds for your startup. The first and probably the most obvious way of funding your company is to bootstrap your company through your own funds. Bootstrapping is simply the term we use to describe building your company from your own savings or your own funds and other already existing resources. So when you're just getting started, it's going to be difficult to raise funding from external parties, because at that point all you have is an idea or maybe a prototype. I've seen a lot of young people with just ideas come up to me and say, "Hey Isaac, I have this idea. Can you help me find an investor that will give me $20,000 so that I can start?" No, my friend, it doesn't work like that. You have to start by bootstrapping your company, get some skin in the game, put in your own money, and then get some traction so that it's easier for other people to come in with funding later. If you have other co-founders, that could be another source of bootstrap funds. You can all contribute money, the money that you need to get started. Also, family and friends are also another source of bootstrap funds. That is if you don't have enough savings to actually get started. But bootstrapping is very important, because then you're able to use your own resources, your own PC, your own savings, your own internet, everything, to get your idea somewhere before to make it more attractive for you to be able to get other forms of funding. The second source of funding I want to talk about are startup accelerators and incubators. A startup accelerator is essentially a startup factory, and then they help to speed up the process of creating successful startups. An accelerator is typically a 3 to 6 month program which involves an intensive on-site training and mentoring of startups. So the way an accelerator works is this: you apply and then you go through a selection process, and when you are finally accepted, you join the cohort of other companies. Then you begin to attend workshops and learn how to build a business, kind of like attending business school, but you also receive mentoring from experienced entrepreneurs. At the end of the accelerator program, there's usually what they call a demo day, where they bring a lot of influential people and investors, and then you have the opportunity to present and pitch your startup to them. Different accelerators structure their programs differently. Some of them only accept businesses in a certain particular field. Others accept businesses from every field. Some will take a small amount of equity in your company in exchange for the funding and mentoring and networks that they'll give you. Some of them require you to move your company to the country in which the accelerator is based. And so you have to do your research very well and understand what you are going into before you apply. And the advantage you get by entering into accelerator is that aside from the money, you also get a lot of mentoring. You're able to build your network, and this is going to come in handy when you go along. Incubators are similar to accelerators, but whereas I think the main difference between the two is that accelerators accelerate your company, which means that you need to have a company already existing. You probably should have done something, have a prototype, introduce it to a few customers, and accelerators come in and help you go to the next level. Incubators, on the other hand, they come in when you are pretty small and incubate your idea and help you turn it into a business and have a business model. So I think these are the two So for accelerators, the best time to apply is when you already have started a business. You probably have a product or at least a prototype. You maybe have a few customers and you are looking to take things to the next level. Then accelerators make sense. Incubators are more ideal when you are still in the idea phase or when you just have a prototype and you are looking for guidance on how to build a business around your idea and actually come up with a business model which works. So I'm going to put a link to some of the popular accelerators and incubators in the description below, so just do well to check it out. So the third way I want to share with you to raise funding for your startup is through startup pitch competitions. So startup pitch competitions are exactly what the name says. A competition where you pitch your startup for a chance to win a prize, usually in the form of cash or other resources. Typically the way it works is you apply and then you go through one or more selection processes to become a finalist. The finalists then pitch on a live stage and one or more winners are selected to win the prize. One of the good things about startup pitch competitions is that the prize money is usually free and you usually don't have to give up equity in your company or pay the money back. Another good thing is that even if you don't win, you might attract some investors that might be interested in your company, and you as a finalist will get significant media exposure for your business, and that could be a good thing for you. The downsides about pitch competitions though is that they're very highly competitive and always the odds are against you, and you have to spend a lot of time to be able to put in a good application. And so if you're spending a lot of time applying for pitch competitions, that is time that you could be spending actually working on your business. And usually the organization that is calling for the application, they specify what kind of businesses they are looking for, what stage the business should be. And so you need to understand all of that and know all of that before you decide to apply, because it's very stressful, and if you get to the final stage and you don't win, the emotions attached, it's really crazy. So for me personally, I only apply for pitch competitions that I think that I have a good shot at, and if I think this is above me or I haven't gotten there yet or it's too competitive, I'm not going to apply. So number 4 is grants. And grants are funds that are given out by public, private, and non-profit organizations for a wide range of purposes. And these organizations are usually referred to as funding bodies. And typically, the money that you receive is non-payable, and they are meant for a particular project with a fixed duration and fixed outcomes. Grants are usually not meant to take care of your company's running costs like salaries, rent, etc. Usually they are meant for a specific project. Typically there's an application process, and depending on the amount involved, it could actually take a bit of time to process the application. One of the downsides of grants is that it involves a lot of reporting. The funding body will usually require you to submit a lot of reports from time to time, and that can be time consuming, and that is time spent outside of actually building your business. Also, grants are quite competitive, and it takes quite a lot of skill to be able to put in a very good grant application. And because grants can only be used for the particular project or purpose that you specified in the application, it is important that the projects that you submit for a grant application should be things that are in line with your company's strategies. Otherwise, you'd find yourself spending time doing things that don't actually advance your company forward. Alright, so if you're enjoying the video so far, please hit the like button, subscribe, and turn on the notification bell so that you can receive an alert anytime I post a new video. Number 5 is public funds. So public funding sources are business support programs that are targeted at startups, and they are funded by usually the government. And so these funds are usually provided at the very early stage before investors come in, because investors typically like to invest at a later stage. Many governments are trying to boost entrepreneurship programs for the youth in their country, so they started paying attention to startups. A lot of them have established entrepreneur support schemes to help young entrepreneurs really get their feet off the ground. In Ghana, there is the National Entrepreneurship and Innovation Plan that supports thousands of new startup businesses every year. Aside from training, they also give them support. And as with many funding schemes, you have to apply, and it's a very competitive process. So these applications are always competitive. So you have to make sure that you try and make your application look as good as possible. So the next one is angel investors. Angel investors are private investors who invest their own money in startups, usually in exchange for equity. They're usually wealthy, high net worth individuals who commit a little part of their net worth towards investing in startups. Sometimes they come together in groups to collectively screen and invest collectively in startups. And sometimes they might also provide some mentoring and guidance to the entrepreneurs they invest in as well. Usually, angel investors typically come in quite early, but before you approach one, at least you should have bootstrapped your startup to a point and then have some traction before you approach them, so that you have something to show them that will make them interested in being able to put more money into your company. Many angel investors have different motivations for investing in startups. Some are passionate about startups because they have been entrepreneurs before. Some also just want some investment portfolios that give them a higher rate of return compared to other traditional investments. The best way to approach an angel investor is to get an introduction from someone in their network, which is why networking is very important for you as an entrepreneur. And before you approach an angel investor, you have to do your own research on them, find out what kind of businesses they invest in, what stage they invest in, what they offer aside funding, what they are looking for, etc., before you go and approach them. So the next source of funding I want to talk about is venture capital, which is popularly known as VC. And venture capital is a type of financing that investors provide to startups that they believe have high growth potential and can scale and become very profitable in the future. Usually VCs only come in when you have already established yourself, at least to some point. At that point, you should have a product, you should have a business model figured out, you should have your business plan, you should have a financial plan, and you should have some traction, and then they come in, put in money to accelerate your growth. VCs typically don't come in to help you start, they come in to help you grow. So this is how it works. You start by establishing contacts with a VC, either by reaching out to them directly or by being introduced by someone in their network. Typically, it's better to be introduced by someone in their network. Sometimes VCs actually reach out directly to you to source potential deals. And next, you share some documents with them, maybe a pitch deck or an executive summary or some information about your business. And if they're interested, they'll probably schedule a meeting with you to talk more. And if they are interested after that, then they start what is called due diligence. They do some initial due diligence, they get some more information from you. If they still like you at this point, they'll do another round of due diligence where they ask for deeper information about your business, and they try to evaluate whether your business is actually a good fit for the kind of businesses that they are looking for. And if everything goes well after the multiple rounds of due diligence, they give you something called a term sheet that you negotiate the terms of whatever investments they are going to give you. And usually VC investments are equity investments, so they are giving you money for a certain percentage of your company, and they come with a lot of terms, like they're going to have a seat on your board of directors, they are going to have preference shares, and etc. So from the term sheet, you negotiate what the terms should be, and after everything goes well, you sign a deal. You receive the money from them, they receive the equity. This is like a very simplistic way of explaining how the whole VC investment system works, because it's actually a very complex system, and I'll put a description in the link below so that you can read about what the process actually is from the point of view of the VC, what they go through and the process they go through to actually screen applications and deals they receive, and how they arrive at the final decision of which companies that they want to invest in. Also, raising funding from a VC is very long and complex and very frustrating sometimes. It can take anywhere between 6 months to 1 year, depending on the size of the deal, depending on the company you are speaking with, and other factors. And even chances that your company will successfully raise money from a VC is very small, because VCs typically invest in less than 1% of all of the deals that they usually get. So you have to expect a lot of no's, and if you really want to raise funding, you have to knock on a lot of doors. So venture capital has been growing in popularity thanks in part to the booming startup ecosystem, and thanks in part to the media as well. In 2019, African startups raised $1.34 billion in VC investment through 427 deals, according to a website called WeTracker. And because of all of the media buzz associated with being able to successfully raise funding from a VC, a lot of new entrepreneurs start to feel pressured that they actually need to go and start raising funding from a VC. But the truth of the matter is only a tiny percentage of all startup funding actually comes from VCs. In fact, family and friends and angel investors contribute more funding into startups than VCs. And so if you're thinking that, and if you're feeling pressured that you should raise money from a VC at all costs, just have in mind that you really don't need to do that if you don't want to, or if your company doesn't fit the profile that VCs are usually looking for. So the kind of companies that VCs typically look for to invest in are companies that can grow and scale and acquire a lot of users within a relatively short time, and whose value can increase in a very short time. And not all companies fit that profile. Typically, the kind of companies that fit the profile are software tech startups. So you realize that most of the funding from VC firms actually go into software tech startups. And like I mentioned, if your business does not fit that profile, don't worry yourself about going to raise VC funding, because it's going to be difficult, frustrating. You're going to get a lot of no's when you can actually spend your time developing the business, maybe growing your business from sales rather than trying to raise money. If you are first starting out, the bank is probably not one of the places you want to be going to raise funding, because typically they only give you funding if they believe you have the ability to pay back. And in the beginning, when you start out, you don't have a product, you don't have customers, and so you have high risks, and banks are usually risk averse, so they are not going to give you funding. However, after some time, when your business is established, you have physical assets, and if the founders also have physical assets that can be used as collateral, then banks are willing to give you funding after you satisfy their criteria. So the way it works is that you go to the bank, you tell them your project, you apply for a loan, and then if they think that you can pay back the loan, then they give you the loan. All right, guys, so that's all for today. If you have started raising funding for your company, let me know in the comment section how you are raising funds, what methods you are using to raise funds. And if you like the video, don't forget to subscribe and turn on the notification bell. Also like this video so that I can come your way every week with another video. So that's all for today. Stay safe and stay awesome.